It's the 18th of the month, and the number in her banking app reads $61. Rent already cleared. The light bill hasn't. She does the math 3 times, the same way she does it every month, and every time it comes out $60 short. So she moves $11 from what was supposed to be gas money, tells herself she'll figure out the rest by Friday, and goes to bed. By morning, the light bill has cleared anyway, a day early, the way bills sometimes do. Her balance goes negative by $4. The bank charges her $35 for the privilege of being $4 short. Then a second automatic payment hits the same underwater account before she can log in and fix it. Another $35. In the time it takes her to wake up, get the kids up, and check her phone over coffee, she has lost $70 she did not have, to cover a gap that started at 4. Here's the sentence this entire video is built around, and it should make you angry before it makes sense. Being poor is not cheaper than being financially stable. It's dramatically, measurably more expensive, and the mechanism isn't laziness, bad decisions, or bad luck alone. It's a structure, made of 7 specific costs, that charges more to the people who have the least room to absorb it. By the end of this video, you'll understand every one of those 7 costs, why each one exists, and why almost nobody who hasn't lived through them ever sees the full bill. Some of what's coming will make you afraid of how close this trap sits to an ordinary life. Some of it will make you angry on behalf of someone you've never met. All of it is real, documented, and happening to someone, right now, while you watch this. Start with the one from this morning, fees. Banks make an enormous share of their revenue from a small number of accounts, and research consistently finds that roughly 80% of overdraft fees are paid by around 9% of account holders, almost all of them the customers running the thinnest margins. A single overdraft typically runs $26 to $35, on shortfalls that are often less than the fee itself. Do that math for a second, a $35 fee on a $4 shortfall is not a percentage. It's a penalty for being close to zero in the first place. Sit with that ratio for a second. 9% of customers, 80% of the fees. That's not a random distribution of bad luck. That's a machine built to extract the most from the accounts that can least afford it, running exactly as designed, every single day, without anyone at the bank having to make a single unkind decision about any individual person. And that's for people who have a bank account at all. Nearly 6 million American households don't, and every single one of them still has bills to pay, which means check cashing storefronts, prepaid cards, and money orders instead. Cashing a modest bi-weekly paycheck at one of those counters can run $45 to $75 a check, which adds up to over $1,000 a year, spent just to access money that was already theirs. Quick question, have you ever paid a fee just to touch your own paycheck? Most people with a stable checking account never have to. That single sentence is the entire chapter on fees. Now picture the moment the light bill fiasco actually created a real, unavoidable shortfall, with the rent due again in 9 days and nothing left to move around. This is where payday loans enter, and it's worth pausing on the name itself, because it sounds almost helpful. Borrow against a paycheck you already know is coming. What could be simpler? Here's the number that makes it stop sounding simple. The average payday loan carries an annual percentage rate around 391%. Not a typo. Nearly 400%, structured as a flat fee, usually $15 to $20 for every 100 borrowed, due whole in 2 weeks. Research from the Pew Charitable Trusts found the average borrower ends up in debt for about 5 months, paying roughly $520 in fees to borrow $375, which means the fees alone exceed the original loan. Nationally, borrowers spend somewhere close to $9 billion a year on exactly this kind of fee, overwhelmingly concentrated in the communities that can least absorb it. And this is only the second of 7 costs. The next one doesn't even require a bank, a loan, or a bill going out. It just requires an address. Sit with the $9 billion for a second, because it isn't a story about anyone being careless. It's the only door that was actually open. Payday lenders don't run credit checks. Traditional banks, for someone with no cushion and a shaky score, often simply say no. The choice most people picture, a low-interest personal loan versus a payday loan, was frequently never on the table at all. The real choice was a 400% loan or the lights going out. Move outside the bank account entirely, because where someone lives quietly rewrites the price of almost everything they buy, regardless of their driving record, their credit, or their choices. Call it the zip code tax. Auto insurers price policies heavily by geography, and identical drivers with identical records can pay a difference of $1,000 a year or more depending on which side of a city line they live on, because insurers price in an entire area's claim history, not just an individual's. Groceries follow the same geography. Roughly 23 million Americans live in areas officially classified as food deserts, without a full supermarket within a reasonable distance, which means milk, produce, and basic staples get bought at a convenience store or dollar store instead, at a documented markup of 20 to 40% over supermarket prices, for often lower quality food. Have you ever driven past 3 grocery stores on your way to a 4th without thinking twice about it? For 23 million people, that 4th store doesn't exist within reach at all. The trip itself becomes the tax. Here's the part that should genuinely make you angry. None of this is about anyone's individual choices. It's about which stores, which insurers, and which banks decided a given zip code was worth building in, decisions made in boardrooms, years before anyone living there today ever signed a lease. Take a breath before the next one, because it's the cost with no dollar sign attached at all, which somehow makes it heavier, not lighter. Now for the cost nobody puts a number on, because it never shows up on a receipt: stress. In 2013, researchers publishing in the journal Science ran a striking experiment. They asked people of different income levels to imagine an unexpected expense, sometimes small, sometimes large, and then tested their cognitive performance immediately after. Wealthier participants performed the same either way, completely unbothered by the size of the hypothetical bill. Lower-income participants, when confronted with the large hypothetical expense, saw their performance on reasoning and problem-solving tasks drop by an amount comparable to losing an entire night of sleep, roughly 10 to 14 IQ points, temporarily. The same researchers then traveled to Tamil Nadu, India, and tested sugarcane farmers before and after harvest, when the exact same person's income swung from scarce to flush within the same year. They found the exact same farmer performed measurably worse on identical cognitive tasks while poor than while, temporarily, not. Same brain. Same person. Same intelligence on paper. A completely different score, depending entirely on how much money was sitting in the bank that week. Let that finding sit for a moment, because it reframes everything that came before it. This isn't about anyone being less capable. It's about the human brain having a fixed amount of attention, and financial scarcity consuming a share of it before a single other decision of the day even gets made. The light bill, the overdraft, the payday loan, all of it is quietly taxing the exact mental bandwidth a person would need to plan their way out, which means the very system extracting the most money is simultaneously stealing the mental resources someone would need to fight back against it. That chronic weight doesn't stay invisible forever. It shows up, eventually, as health, and the data here is some of the starkest in this entire video. A landmark study using tax and social security records, covering more than 1 billion person-years of data, found that the richest 1% of American men live nearly 15 years longer than the poorest 1%. For women, the gap is just over 10 years. 15 years is not a rounding error. It's most of a childhood, an entire second act of a career, a chance to meet grandchildren that one group gets and the other, on average, doesn't. Delayed checkups because a copri competes with groceries. Skip prescriptions, split in half to make them last a few extra days. Chronic stress, quietly wearing down a cardiovascular system for decades before anyone calls it a diagnosis, let alone treats it. Breathe for a second before moving on from that number, because it deserves more than a passing mention. 15 years. Read it again if you need to. Which brings us to the cost that's hardest to see coming, because it isn't a bill at all, lost opportunity. There's an idea sometimes called the boot theory, and it explains something almost everyone has lived through in some form. A cheap pair of work boots costs $50 and falls apart within a year. A well-made pair costs $150 and lasts 5. Over a decade, the person who could afford the $150 spends $500 total, buying twice, thinking about boots for maybe 20 minutes across 10 years. The person who could only afford the $50 spends $500 as well, but in 5 separate purchases, 5 separate trips, 5 separate moments of being temporarily broke again, right when a new pair is due. Being poor doesn't just cost more money. It costs the option to buy things the efficient way at all, replacing a single decision with a recurring emergency. Stack enough of these on top of each other, missed transit connections because a car needed a repair that got delayed, a shift lost because there was no one to watch a sick kid, a certification course abandoned because the fee competed with rent, and something bigger becomes visible. It isn't one bad decision. It's 1,000 tiny forced ones, each individually defensible, that never add up to room for anything but survival. Ask yourself honestly, how many of your own best decisions this year only happened because you had a cushion underneath you when you made them? And that's exactly how the 7th cost gets passed down, not as debt, but as absence. A child raised inside this structure doesn't inherit less money so much as they inherit no cushion, meaning the very first emergency of their adult life, a car repair, a medical bill, a missed shift, lands exactly where their parents did, with no savings to absorb it, and the same 7-cost system waiting, patiently, to charge them for the shortfall. Generational poverty isn't a mindset being passed down, whatever the phrase might imply to someone who's never lived it. Nobody teaches a child to prefer 400% interest. What actually gets passed down is simpler and colder than any mindset, the absence of a number in an account that could have absorbed the first shock, recreated every single generation, at full price, again, until someone, somewhere along the line, finally gets a margin wide enough to stop the pattern from repeating. Step back and look at all 7 costs side by side: fees, payday loans, the zip code tax, stress, health, lost opportunity, and the absence passed down as generational poverty. None of them are separate accidents. They're one connected structure, and every piece of it charges the most to whoever has the least room to negotiate. That's not a metaphor. It's underwriting, pricing, and fee schedules, written down, filed, and completely legal. Here's the question worth sitting with as we head into what actually helps: if 7 completely different industries, banking, lending, insurance, grocery, healthcare, all independently arrived at pricing that punishes the same people hardest, was that really an accident 7 separate times? Or is it just what happens when nobody with the power to change the pricing has ever had to live inside it, budget inside it, or lie awake doing the math inside it at 11 at night. Here's what actually helps, and none of it is budget better, because budgeting was never the problem for the story that opened this video. She knew exactly where every dollar was going. The math wasn't the failure. The margin was. Free fee-light checking exists specifically for exactly this situation, through a nationwide program called Bank On, built with backing from major financial regulators to eliminate the overdraft spiral entirely. No minimum balance, no surprise fees, available at thousands of banks and credit unions that have already signed on. Credit unions and community development financial institutions, often called CDFIs, offer small emergency loans at a fraction of payday rates, frequently under 36% instead of nearly 400%, specifically built to break the rollover cycle rather than extend it. The Earned Income Tax Credit, for working families who qualify, can add up to several $1,000s back at tax time, real money that goes unclaimed every single year simply because nobody knew to file for it or assumed they wouldn't qualify. None of these fix the entire structure, and it would be dishonest to pretend 7 systemic costs get solved by 3 individual tools. But all of them measurably shrink the bill, sometimes by hundreds or thousands of dollars a year, for anyone who knows they exist and takes the 10 minutes to look into them. And if none of this applies to you directly, here's what to actually do with everything you just watched. Stop assuming a thin bank balance means a thin work ethic, in anyone, ever again. The next time you hear someone say a person in this situation should simply budget better, or work harder, or make smarter choices, you'll know exactly which parts of that story they've never had to live through. The math from the opening of this video wasn't a failure of planning. It was a system charging its highest prices to the person with the least ability to pay them, and calling it a fee. Picture her again, months from now. The light bill finally caught up. The overdraft finally cleared. For 1 week, the number in the app stays positive, and it almost feels like relief. The system doesn't send an apology for the $70 it took that morning. It doesn't remember her at all. It has no name for her, no memory of the $11 moved from gas money, no record of the math done 3 times at the kitchen table. It just waits, patiently, unchanged, exactly where it's always been, for the next $4 shortfall, from her, or from someone exactly like her, 3 towns over, doing the exact same math tonight for the very first time. It was never built to notice who it was charging. It was only ever built to charge. And somewhere tonight, the 18th of the month is happening again, to somebody who has never once heard the words overdraft, April, or food desert used out loud, only felt, over and over, what they cost.